Fiscal policy, fiscal policy basically touches on two aspects. We say that it touches on revenue. It touches basically on revenue and what we call the expenditure. So basically, when you talk about revenue, this is the taxes. And as we're doing that, we say that how the government basically uses the revenue and what we call the taxes to control the economy. We also did touch on what we call the objectives of what we call the fiscal policy, how the government uses revenue and expenditure to control the economy. We also talked about what we call the objectives of what we call the fiscal, objectives of the fiscal policy. What we call the objectives of what we call the fiscal policy, objectives of what we call the fiscal policy. One of it we talked about ensure what we call fair distribution of income in the wealth. When you have the progressive taxes, where we tax those that have money highly than those that do not have money, and the money that we basically get from taxation, we provide services to those who are less fortunate in the society. That is what we call ensure fair distribution of income and wealth. But we also talked about as an objective, we say that attraction of investors. And we say that how do we attract basically investors using taxes? We say that we do that by lowering the taxes, and when you lower the taxes, they're able to bring investment into the country. But at the same time, as a way of attracting the investors, we basically said that we basically developed infrastructure using the taxes that are basically generated from the taxes. We develop infrastructure basically from the taxes that we generate. We also talked about what we call economic stability. We talked about one aspect of what we call inflation. And I did say that inflation is basically what we call the persistent rise in the prices of commodity. And whenever there is an inflation in an economy, we basically say that one of the aspects is that we do what? We raise the interest rate and we raise the taxes altogether. Because inflation is a scenario where we have a lot of money in circulation. How do we regulate that? We raise the taxes altogether to make it expensive altogether. We raise the taxes as a way of controlling inflation. But we also talk about protection of what we call the local industry. When you talk about protection of the local industry, we did talk about raising what we call the custom duty. You make it very expensive for the goods that are coming into the country. And therefore, if you make it very expensive for the goods that are basically coming in the country, we know that people would heavily depend on local commodity. We also talk about what we call creation of what we call jobs. If you look at the previous government, and we look at Kazi kwa Vijana, that was a product of what we call the taxes. But I said, particularly on this, when you talk about objectives, some students basically forget. When you talk about objectives of policy, objectives of fiscal policy is the same as purpose, stroke what you call functions, stroke what you call the roles of what you call taxation. When you get into an examination, and basically you don't remember objectives of the fiscal policy, is basically the same as what you call purpose, stroke functions, stroke what you call the roles of taxation. Together. We respond with a yes. So I proceed to what we call the fiscal tools. We start on what we call the fiscal tools. So one of the fiscal tool, we talked about what we call the public expenditure. Public expenditure. And we did touch on expenditure and say we have a current expenditure and we have what we call a capital expenditure. So for the capital expenditure, we say that those are expenditure on what we call the fixed asset. When you talk about a recurrent, so the current expenditure, these are on a day-to-day, like the salaries and etc. altogether. So with the tool, public expenditure, fiscal tool, what we call the public expenditure, how do we use it? How do we use it to control inflation? We know that during inflation, During inflation, what we call inflation. What happens during inflation? During inflation, during inflation, during inflation, what should the government do? What should happen during inflation in terms of government? The public expenditure should be reduced. We need to understand that public expenditure should be reduced. Should be reduced. That is during inflation. Public expenditure should be basically reduced as a fiscal tool. And you have what you call the public debt. Public debt. We did talk about public debt. What happens to public debt when you talk about public debt? So this is what we call government borrowing, what we call government borrowing. Borrowing, we say either what we call internally or what we call externally. Government borrowing internally or externally. Are we together? It is usually used when government revenue. Usually when we say with government revenue, we say it does not meet what we call the government expenditure. Does not basically meet what we call the government expenditure. Does not meet what we call government expenditure. So we say most of developing countries, do they have a surplus budget or what we call a deficit budget or a balanced budget? Most of the developing countries. What did you say about most of the developing countries? They have what we call a deficit budget altogether. Deficit budget implying that, the expenditure is more than the revenue that is collected. The expenditure is more than revenue collected altogether. The expenditure is more than the revenue collected. So that's what happens. Then you have what we call public stroke government public stroke what we call the government budget. Public stroke what we call the government budget. What is a budget? What is a budget? A plan. This is basically a plan on how the government, say intends to, say, raise what we call the revenue, intend to raise revenue, and we say spend what we call the revenue, and spend the revenue generated. So in terms of this, we have basically three types of a budget. We have what we call a surplus. We have what we call a deficit, and then we have what we call a balanced budget. So what is a surplus budget? For a surplus, we know that expected revenue from this expected revenue, we know is greater than what we call the expected expenditure. So then on this scenario, deficit, what we call the expected expenditure. The expected expenditure is greater than what's called the expected revenue. Is greater than what's called the expected revenue. That is on a deficit budget. What about a balanced? When you talk about a balanced, what we call a balanced budget. So revenue, expected revenue is basically equals to expected revenue, we understand, is equals to what you call expected expenditure. That is what you call a balanced budget. Then I want you, for example, to, as an assignment, what happens in terms of borrowing? What happens in terms of borrowing during inflation as your assignment? Inflation in terms of borrowing. Internal, and check for me on the internal. Internally, what should happen in terms of borrowing, and externally during inflation. Externally. So what should happen during inflation? Internally and externally. Together. We respond with a yes. If you're together.